Okay, welcome everyone to the first and hopefully not last cover call ETF investing one-on-one with the aim of comparing and contrasting other finance related experiences in relation to a cover call ETF strategy. I'm Jordan with Scott from the YouTube channel Create.save.invest. Scott creates videos around stock portfolio updates that includes a live stream every weekday morning between 8 a.m. and 8:45 a.m. Pacific Standard Time, commenting on questions from people that follow his channel or otherwise is known more as a virtual hangout space to talk finance. Kind of like what I'm trying to do here. So Scott, welcome to the first inaugural one-on-one here. Hopefully you enjoyed it. I mean, people probably don't know this, but we actually probably got in contact maybe mid 2021, and I first reached out to you about maybe doing a collab. So, hey, a year and a half later, what's that saying? Never too late for
it. Finally happened. I remember that, and well, life gets in the way, but it's awesome that we were able to set this up and to be on your first one. So hopefully I don't. Hopefully I do a good job.
Yeah, for sure. The aim for me is like, I really enjoy just interacting with other people, whether it be a YouTuber or just somebody I know, that's offline, and I can bring them on and just get their unique financial take or experience on something, and then and then kind of tie it back into the cover call strategy. Adrian does a really good job at doing the breakdowns of very specific ETFs, and I wasn't sure if I necessarily wanted to do something like that, but it's an evolution. We'll see what happens. But for the most part, this is for my time constraints. I kind of treat this like a hangout. Like I just, we're just talking in the coffee shop, or maybe I'm just speaking to a neighbor or something. It works out really well that way.
It works because one thing I've learned, like my channel's been going for, it'll be 2 years in April. And for the first, probably basically year and a half, I was just pushing out content that I wanted to push out, and then in the summer started doing live streams every morning before I started my workday. I learned so much more from other people that are joining these live streams than I did in the last year and a half.
And that's what I'm hoping to do. It's like I think we often or can easily get trapped into, here's a YouTuber, therefore we kind of give them a bit of like a celebrity like status because their face is out there, and they maybe have an audience, whether it's big or small. But like I'll tell this quick story. I remember one of your videos. You featured Fandom Finance, my old channel, with 50 videos or so on it. So I've given that up for people who don't know. I gave that. I'm not posting to that. So if you subscribe, there's going to be no new content there. I remember you featured one of my questions, and and this is where that sort of the celebrity sort of, or the fanboyness comes in, because I turned to my wife and I was like, Jess, look, I'm featured in the video, right? I was like, that's so cool. And my wife isn't, she just kind of looks up. She's like, huh, that's interesting, right? She's trying to bug me, of course, but like I'm just like, that's so cool, right? So I had to comment, and it was just cool to experience that, right? So like that being said, with me starting a YouTube channel and trying to get other perspectives on finance, I because I've already reached out to you before, like a long time ago, I thought you'd be just, the perfect guy just to kick things off with. And, when I follow your channel, I don't get the sense that you're trying to trick people into thinking that you know more than you do, right? You're showing people that you're very much trying to learn just like everybody else.
I'm the first one to admit, like, just because I'm buying this, don't buy this.
It's a total journey. So, I mean, for people watching, understand that, yes, I have a channel about cover call ETFs, but just like a lot of you guys out there, I'm trying to learn as well, as much as I can. There's so many questions I have in this space. If in the future, I would really like to get on fund. I have like so many deep I don't know, just like really like nitty gritty kind of questions for understanding the option strategy. I really wish I was a fly on the wall in some of these
Yeah.
rooms, or how they come up with funds and whatnot. But yeah, anyway, like I said, let's get into it.
Awesome.
One of the first things I just wanted to ask you was, what is your take on cover call ETFs? Like, what do you know about them? And yeah, just your
Yeah.
general take.
Yeah, for sure. So, I mean, I've had typically, I mean, the Tesla one is new, right? The Tesla that ETF, that's probably, I think, the one you're mentioning. It's been popular. It's the one thing in my portfolio that's doing good. So that's always nice, right? I've researched doing this strategy on my own, because I use Wealthsimple. Obviously, I think people that follow my channel know that. So there's now is the option for options on certain, if you're in a certain account, I guess they're rolling these out. So I have that. I mean, I do have that option to invest in options. I have no idea what I'm doing. I start as soon as I start researching it, I start to understand it, and then but there's also kind of what comes up is I don't have the time to like actually do this myself, and it's a big investment that way. Not necessarily obviously investment of money, yes, but it's also an investment of your time, and I don't have that. One of the companies I would use that strategy for would be Tesla. So the ETF kind of came at a good time, and I'm happy to. Obviously, it costs money. You pay your management fees to ETFs, but I think they're going to do a better job than I would on it. That's the main reason for going in, and the yield. Not to always chase yield in my portfolio, but the yield is quite good on it right now. That's something I'll have to keep an eye on. But I think just with the strategy of it, can reduce a bit of the volatility, but also give me a yield, hopefully. So that's why I've chosen, but it's only a small portion, right? It's only a really small portion of my portfolio. It's maybe a little bit high right now for my taste, but I think I probably won't be adding any into that position, but it's I've been happy with it so far. It's only been really going for a couple months now.
When I saw your the Google yield max share and the Tesla yield max share, I was intrigued. I know Adrian from Passive Income Investing, he has something similar, but at the time I'm not really focused on sort of more exotic cover call ETFs. I'm more in the stage of building out the anchors of the portfolio.
Yeah.
And there are some things coming my way this year, just things I set up from last year, where I'll be able to expand that. I just won't have just two funds. Right now I have XYLD, which is an S&P 500 ETF with 100% at the money cover call overlay on top of the index. And then I have HYLD, which is just at the moment is the poster child for all things cover call ETFs, right? So for those who don't know, HYLD holds probably at least 5 of the biggest American cover call ETFs out there, and then it has another one in gold, and I think one more in healthcare. Maybe I can't quite remember the 7th one, but nonetheless, I was doing a dividend growth strategy when I first started, and then just with time on the road, work, kids, spending time with and trying to value companies at the same time, and doing YouTube at the same, it was just a lot. And I suffered a lot of burnout from a lot of that, and it really made me kind of question, is the investing thing, how much of it's really worth it? Is YouTube worth it? And you go through these cycles of not, I don't want to say dread, but just wondering, is this really sustainable? Can I really keep this going? And so I remember I had a shirt that said, it kind of tied into the fandom finance thing, which was it took a quote from Star Wars, and it said, and I said, options trading is the pathway to many abilities some consider to be unnatural. And I looked at that shirt later on. I said, I looked at them like, maybe there is something in options that maybe could help me, right? So like, why be ignorant about something you don't like? I think it was a pretty ignorant thing to say, because as it turns out now, it was, right? Because I've taken up that strategy. So I started looking into options that led me to cover calls, and I started reading about it, and I got hooked to it. I was like, wow, this could actually really lighten the load for me as far as, and free up my time. And that's ultimately what I want to try to do. I want to try to, yes, lower volatility. But I also want to spend more time with my family. I want to spend more time with my wife when the kids go to bed. And I don't want to just be so solely focused on the stock market and trying to find that next gem. Even if it's for the long term, I'm willing to give up maybe some potential exponential growth in the share price just for some peace of mind. And that kind of ultimately got me to getting 100% into this, but it was a slow process. I probably started it about a year ago. When I sold off my Suncor position, I had made like 120% on it, bought it for like $15, sold it for $38. And bounced into ZWC, and then slowly but surely over the course of probably about 10 months, I slowly started to transition. And then by November, just a couple months ago, I was 100% into cover call ETFs.
Okay.
After giving my take of how I got into cover call ETFs, is there any reservations? Like, yes, you said you've researched it, and is there any concerns that maybe you have about, say someone like myself going 100% full bore into this?
Yeah. Okay. I always find it's interesting, and I can only kind of speak for myself. It takes, like as mentioned before, my channel's been going for almost 2 years. And that's kind of when I started investing from self-directed. It takes that amount of time. And it's interesting listening to you saying it took you a year and a bit to kind of figure out what you actually wanted to do and get comfortable with what you want to do. And I think that happens to everybody. It happened to me. You invest in things that when you first starting, everybody makes mistakes, right? I've made mistakes. You can look at my portfolio. Is it a mistake? My portfolio has always been a long-term portfolio. So the positions that are down, sure, there's probably ones I should have dumped off sooner, but you learn that as you go. But then you learn to figure out where you're comfortable putting your money. And if I'm comfortable putting it into something now, the Tesla, like the yield Tesla share using options, is probably going to be a bit more volatile than some of the ones you're choosing, but it's also it's a smaller percentage of my portfolio. So everybody's like, that's the one thing, is everybody's different, and it's being comfortable and knowing enough that you're comfortable with partly the volatility of it potentially, and but it takes you time to actually figure that out with where your money is better invested. It sounds like we've gone along a lot of the same journey, like even though we've owned different shares and different companies and different products, every investor seems to go through that journey, right, of the beginning, and then they finally figure out. I'm only just now kind of finally figuring out what I want to actually be invested in my TFSA, and it's really the options is a small portion of it, probably sitting around, it's under 10% of my portfolio, closer to 5 or 6%. The rest is in boring, I mean, some wouldn't say necessarily boring, but S&P ETF, and a Canadian dividend ETF, not even using covered call options on that. So everybody's kind of different, but they kind of get to the same spot eventually, which I find is interesting.
Yeah, no, I do as well. I think I would say for myself, I think what the cover call ETF space. So maybe I'll give it this. The typical knock against cover call ETFs, or at least one of them, is, well, Jordan, you're 33 years old. Why do you need income? Why do you need income? Well, right. I mean, the typical response for maybe someone my age is going to be, well, I don't need the income right now. But I am going to reinvest all of it. Now, what people might not know is that I do plan on drawing from that income, start like slowly, probably within the next 5 to 7 years, roughly, at least starting to draw upon it. I will still reinvest the rest, but it's going to be a bit of a sliding scale. I do want to enjoy some of this income that I'm making from it with my kids, right? My oldest boy is 6 years old, so there is a level of, or a time frame where I want him to be able to see the fruits of these investments reinvested. So at the current moment, my oldest boy is the yardstick, because I know I'm the oldest kid of all my three other siblings. And so as we grew up, the oldest one doesn't typically get to see all the fruits of the higher income of, say, your parents, who naturally typically, right, they get a better income as they get a little bit older. They save a little bit more, invest a little bit more. For my youngest boy, who's like 10 months old, like, he's certainly going to see the fruits of that. But I would like to show that for at least him, my oldest, that this is like, I want to do stuff as a family, and this is one way of investing to show you that we can do that and achieve things as a family together. And we also do as a family. I put jars in front of them every day, and I give them, like, say, a jube, and I say, what do you want to do with this jube? And there is a reason for this. I say, do you want to eat it, or do you put it in this jar? And so when we first started doing this, they would eat it. But what I'm teaching them is, if they put in the jar every 5 jubes, I give them an extra. So if they have 5 jubes saved up in the jar, I'll give them 2 a day. Once they get 10 in the jar, I give them 3 a day. Once they get, what I mean? So it's teaching them how things compound. And once they fill up the jar, I get them like a little toy, right? So it teaches delayed gratification. It teaches a little bit of how the investment realm works, and how to compound. So, like, my kids know the term compound. They're just like, compounding those jubes, daddy. Like, awesome. Love hearing that. So that's a little bit, at least on the personal side, why I do it. Also too, there, Scott, I noticed, I was really curious. So I went back to one of your first videos, and I wanted to see actually how many of the same stocks you actually had in your portfolio. And I think you have 3. I think it's like Greenlee,
I probably still have,
and
I TransAlta probably still have.
That's right.
And Cielo probably still in there.
Yeah, I think it was those.
That's my learning experience.
Right, but there they are, still going strong. And I just thought, I was like,
well, not so much. Greenland, I think, will do well, actually. You got to have, this is the thing, you can be smart, but you can also have a certain bit of fun money, right? That you can, it's a gamble. I mean, investing a lot of times is a gamble in certain things, right? But if you look at the portfolio, it's a very small percentage. I wish, of course, you want everything to go up, but I've said it before with Cielo, I should have sold sooner, because I think at one point it was actually up. I'd have to look back. It's probably up. I should have just sold it, but you get. This is where you learn, right? You learn from your mistakes. I didn't, so now it's not even worth selling. But then I look at it going, okay, well, in my 47 years of life, I've spent $175 on worse things, right, that have disappeared. So I look at it that way a little bit. Obviously, you don't want to lose money when you're investing, but it's always fun to take some risks with things and have a little bit of, if you enjoy it, you find it some fun. It's the money that I invest in my TFSA, I'm not investing money that obviously I need, you know what I mean? I mean, you need it, yes, right?
Yeah.
But I'm not putting more in there than I'm not putting money in an investment because I'm gambling to think it's going to go up because I need it. You should never invest more than you can afford to invest, right? So if you want to take some other risks on certain things, I think that's okay, because that's all part of the learning, right? All part of the learning. You just learn from your mistakes. Hopefully they're not big ones. And then it takes a couple of years, like for me, and then you finally figure out, okay, I'm better off just putting my money into the S&P and into the TS, into those two ETFs that I have that are. I'm going to say one of my last videos is saying investing is boring, but it's not. But if you're putting into the two things every day or every week, it kind of is. But you're going to benefit more from it from not gambling.
And
Really.
those two ETFs you're talking about is VFE and VDY, I believe.
VFE and VDY, yeah, the Vanguard, yeah, ETFs.
Yeah. So those
they're
are
they're probably, I think, one of the most popular ones.
Oh, they are. They're
VFE
up.
for sure.
Yeah, they're up there as far as
Yeah.
just money inflows into ETFs.
Yeah.
They're up there, as at least in the Canadian space anyway.
And I mean, VDY is good. The dividend's good. The dividend comes in. I just buy a fractional share. You don't even think about it.
Yeah.
And you don't have to stress.
Oh, absolutely.
About when to buy and when to buy, when to sell.
Yeah.
So
I remember you were part of your, I guess, mission with Create.save.invest, or one of the things that you've or espoused to do with it is the $100,000 creator challenge.
Yes.
And with where your portfolio is at currently, did you expect to be, maybe farther ahead, farther behind? Is this kind of where you expected to be? Or were you kind of just blank slate? You didn't necessarily, you're like, I'm on this journey. I don't know how long it's going to take, but
I always kind of figured it would take me about 10 years, because that's kind of realistic, right? Try and put in $10,000 a year. Obviously my TFSA, this is my only TFSA, so you can see how much room I have left. So obviously it has to take a number of years before I can even kind of get to that, depending what the amounts are. But I kind of figured around 10 years, obviously with hopefully appreciation as well. I think it's going to be less than that, actually. That's my goal. I think my goal is to kind of have it maybe within another, ideally would be nice in 5 years. That would be nice.
Yeah.
You really start to see it snowball after a couple of years. Like it's like I track my dividends, and my dividends every month are now double every month, or when they first start out, right? Because everything's getting reinvested. Typically in the same. If I can buy a fractional share on something, the dividends go right back into the same one. If I can't, I usually just put it into either VDY or VFE if I have some extra. So
yeah, no,
that's one thing that's really surprised me, is the amount of distributions coming through that really add up.
Have you been recording your dividends distributions in an Excel chart every month?
I just have a basic Excel spreadsheet. It breaks it down. I have to total them up monthly. I total it up, put it in the month, and then it breaks it down into quarters, and it breaks it down into the year for me. Yeah.
No, that's great. So for people who aren't doing that, and if you're newer, really get on that, because when you're able to see month over month, and especially in the dividend space, or you're collecting distributions from cover call ETFs, it is so motivating to see that grow, that total grow, even if it's across a few different positions, or maybe it's just one. But it gives me extra motivation, because what I say to myself is, look at what's happening every month. Like whether I deposit money into the account, buy more shares, or I reinvest it, I continually give myself a raise. I don't rely on any company or contractor or whatever the case is. There is no third party outside influence. It's just that's totally under my control. And when I tell people that I give myself 50 raises a year, people are like, what? Right? We're so trained to think that our one bonus or our one, inflation or CPI adjusted raise every year is like the be all end all. But, when you get into the investing space, like, wow, it is so crazy just to watch that grow every month. And especially if you track the percentage change month over month, like, yes, you can see that the total is growing, but it's like by how much percentage?
Yeah. My spreadsheet's not that technical, but it works for me. So I see it and you just see the number and you're like, okay, that's awesome.
No, totally. I do the same thing.
It's
I keep it
reassuring.
simple. I do the monthly totals of each position, the grand total, and then one more column just for a percentage change, like a total percentage change month over month. And I'm like, wow, I'm compounding, like, some months it's like 2% a month. Like, that's wild.
It's nice.
But I'm also
nice. It's reassuring. It's nice. That's one thing. It's nice to get those, you get those emails or the notifications and you get it a little dividend. It kind of like, oh, it's actually working. I've got $5, $10, and I mean, my portfolio.
It's a dopamine hit, that's for sure.
And it gives you that, right?
It's a good kind of dopamine hit. I think.
It is.
I think
it is. And well, I mean, sometimes underlying shares might be down. But at least you're getting that build up. And the biggest thing is not to forget your time. That's the one thing I've really learned. You have to really be patient. It's hard though. And I know you left a comment because I did that post on, investment being boring, and sometimes you really want to take some time away for family and you pay too much attention to something. It's not good. It's that's the one thing I have learned, and is to really be patient, and don't forget your time frame, right, for stuff and why you originally bought the shares. And it's hard when a portfolio is down, or positions in your portfolio are maybe down more than you wish they were. Obviously everybody wants to be in the green, but I think if you stick with your plan, eventually, hopefully it can pay off. If anything, for me, like, part of this challenge of getting my portfolio to $100,000 is I wasn't investing in a TFSA. I had an account where I would put a biweekly amount into my RRSP, and I would get a quarterly statement. I wouldn't pay attention. And all of a sudden now, if I'm using my TFSA and self-directing it, it's a lot of it, like, it's just lifestyle changes. All of a sudden I think now, okay, I don't go out for dinner anymore. Some people might say that's boring or whatever, but I cook from home. So I can look now and go, okay, instead of spending $50 on a dinner and a drink, I'll put that $50 into my TFSA, and it's there. And I kind of look at it. Obviously, you don't want stocks or anything to go, you don't never want anything to go down. But if for some reason I'm invested in something that doesn't perform as well, let's just say cryptocurrency, Bitcoin, that ETF, not doing that great right now, but that money, I think, kind of like that I would normally put in that as a riskier investment would have been gone. That's how I kind of think about, with my portfolio. It's stuff that I would normally be blowing on with nothing to show, and stuff that I don't need or something like that. So I've really shifted my, I guess my whole life. You kind of shift your whole life around and started really to focus on investing.
And when did you, I would say, start taking this more seriously, like doing self-direct? And
typically when I started doing the channel, when I first started with Wealthsimple, because I think it was 2020. I think I must have saw an ad like on YouTube or something like that, because I have another YouTube channel, right? I must have saw an ad because there was Wealthsimple ads everywhere. I thought, okay, well, let me look at this. And I first started on the invest side, which is their robo-advisor, which is all ETFs, right? And the reason for switching was because of fees, because the other company I used because I had a RRSP, and I had an old company pension that has turned into a lira, and it was sitting in, and when I left the company I worked for, I had to move. I was no longer in the pension plan, so I had to move it. And I got the quarterly statement, and I looked at what I was paying, and I worked it out. It was mostly for the lira, because the lira, I thought, well, okay, it's invested here. I'm paying X amount of dollars a month, but I can't put any more money into it because it's locked in. So the only increase in value is any kind of appreciation. But if I'm paying, you break it down over the year, how much fees I'm paying on it. If you multiply that over the next, 25 years, it's not worth, you know what I mean? So I looked for somewhere that was cheap, less expensive. And that's where I've found Wealthsimple Invest. And then of course they kind of tie you into the system, the ecosystem. And then I decided, hey, I should get a TFSA. I'll try this out. And there you go. That's the rest is kind of history. So I've really been self-directed for almost 2 years. Typically you can see the first deposits on the channel. Yeah.
That's awesome. I started with TD Direct Invest, and I think I don't know. I think but I also wanted to try out Questrade at the time. So I had some money in Questrade, had some money in TD Direct Invest, and then I had with Wealthsimple, I don't know. I just read it, like I was looking for something with, just free commission basically, or $0 commission trading fees. And as soon as I saw it, for the people that I kind of knew who did their own investments, I went to them right away and I said, guys, this being at work, like, do you guys know about this? And none of them knew. None of them. So, and it's just so funny because now for the people who do invest, we're basically all on Wealthsimple now.
Yeah.
I transitioned pretty much everything over into Wealthsimple. The only thing I didn't, so like if you look on my portfolio on Blossom, you'll see XYLD, HYLD. HYLD is everything in my TFSA. I don't think I will buy anything other than HYLD in my TFSA. Never say never, but that's kind of where I'm leaning towards with that. But with XYLD, I actually keep that in a spousal RRSP in Questrade only because they offer it. And last year, when I checked my deduction limit early last year, it was like at $52,000. I had not put any money in it whatsoever over the years, but I also get a defined pension at my work. So the way that works is that, my work contributes X amount of dollars to the RPP, Registered Pension Plan.
Yep.
And then the rest of it is available for my RRSP as the deduction limit, but and the contributions carry over every single year until they basically hit 52,000. And what I realized is like, wow, it's like if that's obviously a big tax refund if I'm able to do it all at once. But another big one was like, but I kind of also want the flexibility to take it out without paying any tax. And as it turns out, there is actually there's a little caveat that I don't think a lot of people are aware of. So like when you invest or when you put money into a spousal RSP, you like for me, because I'm the income earner, my wife is she doesn't make any money. It's in her name, so I contribute, I get the tax refund, but it's essentially her RSP RRSP. Now, as long as I keep contributing, and if I take money out, I have to file that under my taxes. But if I contribute, say 5 years down the road, I stop contributing, I have to wait 3 years. There's a waiting period. You wait 3 years. And after that point, if she wanted to draw out money, then that's on her. That's on her tax.
Okay.
She would have to file that. And because she makes no money, and because we have up here in Canada that $15,000 basic tax exemption, so you can make up to $15,000 in Canada without paying tax. And each province varies. Like here in BC, currently it's about, I think, between $11,000 and $12,000. So essentially, eventually I will stop contributing to that. And for flexibility purposes, we could take that money out tax-free in the future up to that amount without paying tax.
Amount. Yeah.
So that was my reasoning behind that, was to get into that, was to, yes, give us flexibility and also take advantage of and draw down the big get a much bigger tax refund. So coming into this year, I wrote it. It was one of my first posts I put on Blossom, which was like, I guess my goals. I actually didn't think anyone would see it when I first joined Blossom. I didn't think I thought it would be like, it would be so crammed with people, like nobody would pay attention. As it turns out, that wasn't the case. So I just put out, the fact that like I'm expecting, an over $20,000 tax refund this year. And I will reinvest that right back into it, and knowing that I will be able to potentially take that out in the future. So, I mean, for the people watching out there, if there's any caveats to that, maybe that, I'm saying this is not necessarily for everybody, because it's not for everybody, because one, you either have to be married with a common law spouse partner. One person essentially isn't working, and it's like with a bigger deduction limit, that certainly helps out a lot. But anyway, people can comment down below if they see any issues with that at all. But I mean, I don't know, as much reading and research that and time that I put into that to try, I didn't necessarily see anything else. But hey, we all got blind spots, and then there might be some. So feel free to comment down below what you guys think about that little RRSP, spousal RRSP maneuver.
There's lots of they're not loopholes, but there's lots of things that don't, like,
loophole is probably the wrong word to
it's the wrong word,
because it's it's true. We use the
strategies.
Word it is a strategy, it is a legal one. It's just, I think when we use words like loophole, it's almost like it's to convey information, or to convey something that like most people maybe don't do, but it's perfectly within the bounds.
It's perfectly, that's where I think that's where a good possibly a good accountant would help for a lot of people too. I say that a lot on the live streams, like don't take my my advice, because what works for what I'm doing necessarily won't work for you, and what you're doing won't work for me. And you have to make sure that this is where professionals can sometimes come in, do your own, it sounds cliche that every YouTuber says that, but it's true. I always kind of say, there's lots of different opportunities out there that I think people just have to look. If you look deep enough, you'll find some. And Blossom's a pretty good community, I think, for something like that. We were going to talk about Blossom.
So maybe let's pivot into that. What is your, because what is your take on Blossom so far? What are you learning from it? How are you maybe teaching others through Blossom, or joining people to your, or bringing people to your channel?
It's interesting. I'm not, and I'll admit, I don't know if I'm necessarily the target demographic for Blossom. I think I'm probably a little bit on the older side. It makes myself sound old, but I'm 47. I don't think that's the I'm not probably their target. I like it. It's a good way to find other people that are obviously like-minded, right? Like that's the one good thing about that type of community. Everybody is into investing. It's interesting you can find other people's portfolios. So you see overlap, right, with what people invest in. It's interesting to find everybody's got their own strategies. Everybody's got their own risk tolerances. Everybody's either starting out, been doing it for a long time. So I do find that interesting, because you can kind of learn things, and it's almost more of a reassurance sometimes, going like, okay, I own this, I own this ETF. Is this a good one to buy, to have? And you can kind of see, okay, well, this X percentage has this in their portfolio. It's probably not a bad idea. There's quirks of it that I'm not too keen on. I've said it before, I don't sync my portfolio there, just because it's not a security thing, but it's kind of thing where, will I keep being there, and do I have to remember to go back to cancel my account or whatever? It's just, it's a thing that way. But I do keep it updated when I remember to do it. But it's a good community. I found some other YouTubers on there, other channels, which is good. I try not to. I've shared mine a couple times, but I think more and more, because more and more people are doing that, I've kind of stopped sharing my like links to my channel, because I think if I post something or answer some questions to someone, I find I probably answer more questions and say post something out. If someone wants to dig deep enough into who I find my profile on there, they'll see my channel and they can subscribe if they want to. So that's the problem with sometimes these social media type things, is people are always like pushing to get you to come and watch their stuff. But there's also some good accounts on there that I follow that you can learn from, and that's it's been good. Yeah. So I like it. The hardest part is you have to, again, this comes down to time, right? And like investing, how much time you want to spend investing and everything else. It's like, there's only so much time in the day to focus on certain things. And I'm not over there a ton, because I'll check in on it, but I'm not over there a ton because of time is more valuable in other places. And in my case, I have a job, obviously, but if I'm spending some time creating, I've decided to create on my channel. But doesn't mean I can't suck in other people's information. So,
yeah, I think I'm not sure if we touched on it earlier in the video, but fine, I'll give you my take on Blossom so far. One thing I've been really looking for has been just truly that community aspect of something that I really value and am interested in, and finding those other like-minded people who are out there. That has been one of the best parts about Blossom. I know a lot of these people are also kind of in my backyard here in Vancouver, which is great to see. And I know I've asked, let's do hangouts. I've even done a post, inviting people to the entrepreneurial group I'm a part of called Find Your Niche. And it's just people just mentoring each other, trying to support one another. And it gives that sort of the physical element of getting together, being a coffee shop, being face to face, and just showing other people that I care about what you're trying to do. And you never know what we can learn off of one another, or connect, or do business, or you just never know, right? Because often that's how the dominoes fall into place, is where you least expect it. And it's just about putting yourself out there, and whether it's success or failure, you just learn from it, move on. But I've just enjoyed sharing just my hot takes on of course the passive income investing strategy and the landscape around that, and the feedback that goes along with it. Luckily there isn't I haven't really found, we don't really have anybody who's really just out to lunch, that I would say. We don't seem to have, and that's why I don't join Reddit. I'm not on Twitter. I don't like any of those places, and I never have. I was never part of any chat forums growing up. I just never liked any of that stuff. So for me, joining Blossom was a real, I see all these, Brandon, Adrian, Robin, join Blossom. I'm like, okay, fine. I'm going to just try it out. I don't usually join stuff like this, but I'll try it out. And, I kind of got around to it, and now it's something that, like yourself, if I'm at work, it's just go mode, and I can't really
it's good because there's a lot of regular people on there, right?
Oh
yeah,
yeah.
It's not all, YouTubers or people promoting whatever. It's a lot of just regular people that have investment portfolios. And
I would say that if that really started happening a lot, like if you saw, if the feed was just
promotion,
thumbnails and people's businesses, I would say, hey Max, you all gotta get like if someone posts like a thought or a video or something, like there needs to be like a separate tab for that if people are interested, and get that off the main thing. But I don't know, it's
evolved. It'll evolve. It'll figure out its thing.
Totally,
where it
it's
fits,
an ecosystem that's still trying to figure itself out. I mean,
it's a good way for, I find, like, this is the hardest part with investing, is like, what the heck do you invest in? And especially with, I mean, if you're just investing in ETFs, I mean, there's the staples, right, that are pretty standard S&P ETF, but there's so many other ETFs. You have a couple that I've like literally never heard of, right? And it's a good community for that, I think, to find a Canadian, right? So it actually is, it's a bit more relevant than a lot of the American stuff that is out there. And it's a good way to learn. You can learn so much from other people. It's amazing.
I know I see that we're running out of time, so I thought I'd hit the last thing here on with our one-on-one, and then maybe I'll get your take on it. I'll just wanted to answer this question that Bradley had for just off of Blossom. Serious question: how do you value cover call ETFs? In my investing practice, I find it incredibly important to identify a fair value of an investment, then buy below intrinsic value. How do you do that with cover call ETFs? How do I know if I'm getting a good price? And how can I project what earnings and income will be in the future? A business is only as good as the free cash flow they produce. And how do you determine if the value today is worth the price tomorrow? Charlie Munger says no stock is worth an infinite price. So how do we know what the price to pay is? I thought it was a good question.
That's a good question.
Oh, it's a good question.
I don't know. That's like,
yeah, right. It's a fantastic question, and I'm actually glad Bradley asked it, because when I saw the question, I was like, you know what? I need a little more time. Like, I can't respond to that right away, but I thought that because I knew we were doing this would be a good chance to address it. So I would say this. I would say that if like any ETF out there, the way in which the way in which you measure whatever it is, cash flow, yield on cost, any of that stuff, probably the best way to value a cover call ETF, just for ordinary people out there, at least to start, is the cover call ETF achieving its purpose, right? You go to the prospectus. A lot of the times the prospectus will say something along the lines of, this ETF seeks to provide net of expenses exposure to blah, blah, blah. And it also tries to achieve these other aims. And sometimes it'll give like a specific yield. Like HMAX is a good example, which is the Hamilton financial maximizer. And it's seeking a 13% yield. Well, it's seeking that, but let's just say if the share price goes higher, that yield goes down. Maybe it hits 11%. Well, that might be a good indicator that cover call might be overvalued, because these funds are very specific in what they are trying to achieve, right? And now if it drops and the yield goes up, well, I mean, obviously there might be some signs that it could get cut. But I think for anybody who's curious at trying to understand how to value a cover call, that might be the best way for now. I'm sure there's other ways, but like I said, I'm trying to learn that all the same. There's also the NAV, right? The net asset value, assets minus liabilities, divided by outstanding shares. With cover call ETFs and any ETF in general, the NAV and the share price are usually pretty close, unless they're split shares. Split shares haven't quite gotten into the full understanding of how that works. I don't understand exactly how those work, but usually the NAV and the share price are farther apart. So hearing that, what do you think, Scott?
I think you nailed. I think you actually kind of nailed it. It's tough. I mean, I can kind of talk with the one eye, like with the Tesla yield share, mostly getting in at a price I'm comfortable with, that I think makes sense. But it's every share is so different, right? Because it's going to have probably a different. You're going to look at it differently if it's one underlying share in there as well. You can obviously look at it differently than as opposed to an ETF of an index or whatever you're buying. Look at the history as well, right? You can go into I always kind of say for people, look at if you're thinking of an ETF, is get into the nitty gritty of the ETF, look at the past performance of it. Obviously that doesn't always indicate future performance, but it can maybe give you a bit of idea that way, what's going to happen, and research it that way. And then you kind of know if you think it's a fair price.
I think ETFs in general are a way of you stepping back, right? They are what would be the best term for it? It's like the lazy man's investment, essentially, right? You're wanting to, you don't necessarily want to do the work, so you want to free up your time. And so it's a bit of an apples and oranges comparison, I think, right? The way you value a single security versus how you value an ETF. Maybe there, I'm sure there is like overlap in that, but oftentimes when people pick an ETF, they're doing it because it tracks a certain index that they like, and it's at a certain price.
Sense.
And they're just like, and most people are just going to dollar cost average into it and buy it every month. It doesn't, regardless of the cost. And I think that's ultimately how most people are going to do it. Whether that's right or wrong in the eyes of a particular individual, it's not about how it should be. It's just, that's what it is. And with cover calls, for me, I'm trying to achieve a certain lifestyle in a particular time frame with a certain net worth, that where I'm buying my time back. You pick ETFs because of a particular, you want to lighten your investment load. You don't want to necessarily pay as much attention. You want to participate in the market, which is great, but I have a full binder full of, just because I used to like writing out my own valuations and taking equations, benchmarks, and any kind of bits of info that I could to evaluate a company. I used to do that, still enjoy it. I would still do it. But again, my time is precious and I don't have a lot of it. And ETFs have been a great way of just being able to say, I like doing this stuff, but I gotta be a lot more realistic with my time constraints. So I'm gonna build around these ETFs and I'm just gonna let them go. And especially with cover call ETFs, they don't have the biggest history in the world. I think some of the biggest ones out there are the Global X funds. They have, roughly a 10-year track record. They haven't gone to zero. What people, I think, don't necessarily realize about cover call ETFs is a bunch of them actually do reinvest back into themselves. So the argument with cover calls is that the ETFs, the price will collapse over time. There'll be capital decay and it'll wither away. But I think the fund managers, why create a product that's going to sell, or is going to self-implode? That would be just I think that would be terrible for the reputation of any of these funds or the fund managers, especially the ones who specifically focus on like cover calls, right? You're going to destroy your own business if these funds go to zero. So what they end up doing is a very clever way of capping how much you get paid out every month, and the rest just gets reinvested back in, and it buoys the share price and kind of helps it like just maintain a certain price range. I don't expect the price to go up, and obviously going down, it's going to try to stay within a pretty narrow band. So anyways, Scott, any final thoughts on anything that we touched on that you'd like to say, maybe before we end this? Just final thoughts.
No, thanks. It's been fun. Thanks for having me on your first one too. I feel honored. That's great. We'll do it again for sure. If ever you want to, these are always a lot of fun. If you ever want to, as well, I'll extend the invite if you ever want to come on to over on my channel, one of the live streams where we do at a weekend live stream. We should definitely set that up. It's a lot of fun. It's nice to finally interact with people, and especially to talk about a little bit about investing. I know there's like so many things to talk about.
Oh, I know.
And it would be it's just great to kind of.
It is. I know I was like planning on capping this at like 20 minutes, but like I got like a timer going here. It's like well over an hour, because this is typically how these things go. It's just like
they go in these
for myself, no matter who I talk to.
Places.
It's like I just want to keep going. It's like, just anyway, there's so much to discuss there. And that being said, I just want to, of course, thanks Scott for coming on to the channel, and especially for the inaugural one-on-one here. Just make sure that if you like what you saw, please do so kindly and hit all the buttons of the like and subscribe variety. And hopefully you guys sub Scott if you haven't done so already. And just yeah, stay tuned for other content that I'll be coming out with in the future. I plan to do, I have oh man, I have a ton of people in mind that when it comes to these one-on-ones, right? I'm looking at getting somebody on who built a robotics company and is using that technology for a dating app. A millionaire construction worker. And yeah, just, I mean, I don't know. I just, anyway, though, that's the hook. It's like people like that. And of course, you know, we'll see you with other YouTubers. And of course, Scott, anytime you want me to come on to your channel,
Yeah.
I'd be happy to do so. I think even with you, because I know how open you are to this, I'm sure we'll make this, you know, a regular thing every once in a while, and just keep in touch. And
yeah, I'd be happy to. It's always good.
sounds good. Okay, Scott, thank you. And we'll see you in the next video.
Thanks for having me.